Hello and welcome to another Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd on the direct trading team, hoping to give some views from the trading floor here at Onyx.
Just to be aware, this was recorded on Friday afternoon, a couple of hours after Powell's testimony due to the bank holiday in England on Monday. And today, to start with, we'll be talking about Powell's Jackson Hole testimony and also the weak manufacturing PMIs globally.
We'll take a look at inflation within the UK and the soft prices we've been seeing in crude oil over the past week.
We'll look, of course, at, as we do each week, the OIS pricing to see what's priced by the central banks in the forthcoming central bank meetings. And we'll also look at the week ahead, key markets, key trends, key charts and key risks. Let's start with Chairman Powell's Jackson Hole testimony that came out just a couple of hours ago. To summarise, basically, he was dovish, but he made it clear that the Fed would be data dependent. Something we've discussed internally this week was what we would expect. We expected exactly this because the OIS is pricing between 25 and 50 basis points of cuts at the September meeting. And that gives the Fed a month to watch the data, and Powell clearly didn't want to have to paint them into a corner 25 or 50 this far in advance. Key things he said: the time has come for policy to adjust. And also we saw yesterday Fed's Waller, another Fed member, Fed president, saying that he expects a rate cut at the next meeting. He said, we do not seek or welcome further labour market cooling. So they're clearly quite concerned about employment. He said, my confidence has grown. Inflation is on a target, a path to 2%. A key sentence, inflation risks have diminished, labour risks have increased. Something we touched on last week. CPI risks are now clearly behind us, and employment is the key risk ahead.
Yeah. I mean, it's a very political statement from him, isn't it? The language used, the rhetoric. Labour market is now less tight than before the pandemic, I think is quite a political way of phrasing things. But it does seem as though they're being forced into action. And as you say, this 25 to 50 basis points rate adjustment does feel inevitable, doesn't it?
Yep. And on that as well, he said the pace of rate cuts to depend on the data. We have the 5th of September payrolls, which I think will be absolutely crucial. And a interesting final sentence, he said the current rate level gives ample room to respond to risks. And I think this is a direct point to focus on the recent yen carry trade blow up. Basically reference to that. And if we do see such volatility again, it highlights the fact that, of course, the central bank can cut rates to support the market.
Yeah.
We did have another cut from a central bank this week. The Sweden's Riksbank cut 25 basis points to 3.5%. Again, the good news coming to markets at the moment generally is from central bank rate cuts. Little from the data. Overnight, we had Bank of Japan's Ueda was actually surprisingly hawkish. Japan's inflation staying above the BOJ's target. And it said overnight as well, we had Fed's Harker saying, I'm ready to start the process of cutting rates. You can see back to our old favourite chart here, dollar yen is the orange line and the 2-year interest rate differential, the black line. Clearly they're back, the correlation is clearly back in line and strong again. But again, to highlight what you have here is a Japanese central bank speaker overnight. The head of the BOJ is more hawkish, and we've had the head of the Federal Reserve slightly more dovish.
Yeah, they're reconverging, aren't they? And obviously at quite an alarming rate if you just look at the charts we just showed. But as you had pointed out, when you've got this prolonged period of very clear correlation, even if you just eyeball it, and then this point of divergence, to see this coming back together, I don't think is a particular surprise.
And with the interest rates moving as they are, you'd expect it to dollar yen to head lower.
Yeah.
Currently trading at 144.70, supports coming in around 141. I'd expect that to break in the weeks ahead and head lower. On the data front, we had PMIs come out yesterday. One thing, especially in the US, the overall PMIs came in above expectations. But what we're focusing on here at Onyx tends to be the manufacturing side, of course, because our focus is on the energy products. US manufacturing PMIs came in at 5-month lows. You can see from the chart here. German manufacturing PMIs also at 5-month lows. French manufacturing PMIs at 8-month lows. French service PMIs did spike due to the Olympics, but from certainly obviously a manufacturing perspective, this is pretty weak. From a Brent demand, a crude oil demand perspective and a commodities perspective, this is pretty poor news as well.
Yeah, if you're trying to gauge accurately the underlying sentiment in a market or the behavior, flash in the pans like the Olympics are all well and good for short-term spikes, but can really cloud the picture. And I think this illustrates that we're not seeing that sort of growth that a lot of people would want. And yeah, things are floundering across the board, whether it be in Europe or the US.
And again, in the US, the service sector is 3 times larger than the manufacturing sector, but that's what's keeping the economy afloat. Although what we have seen, we'll see a bit later from indexes like the Philly Fed, is we're seeing weakness in employment there, which again now is the big fear for the central banks. And while we're talking about commodities, Brent has been trending a bit again lower this week.
Yeah, we're on the Brent side of things. It's a similar conversation to those that we've had over the previous weeks. There doesn't seem to be any particular reason for things to be super bullish right now. You're having, demand forecasts and assessments are relatively low, whether that be in the US, whether that be even China. I don't think sentiment is particularly bullish.
A key point with the chart here on Brent is you can see over the last year and a half, the peaks to troughs, it's got narrower, the range has got narrower, volatility is falling, but you can see we're converging, it looks like we're heading towards this key support of 72 down to 71.55 range. Key risk is there's lots of stops below there. So the speculators that tend to be long in this market, because the market tends to spike on OPEC news or geopolitical news, specs tend to be long, and there's going to be a big wall of stops just below this sort of 71.55 level. If those get triggered, we'll likely see an aggressive move lower. As we said, the manufacturing data we're seeing is consistently weaker. China data is consistently weaker.
Yeah. No, the picture out of the East is definitely poor. And I think also from a demand perspective, there's a clear case that there shouldn't be a huge rally in prices, but also there are no real supply concerns at the moment. And I think non-OPEC production and exporting of crude remains at good levels. So I don't think you're going to be seeing any particular price rallies based on, similar fears to what we've seen over the past 2 years or 4 years with geopolitical events. There does seem to be ample supply of oil and oil-related products.
It seems to me as well, we keep having the same conversation about weaker data. And something I used to find when I was trading is you'd see the way the market's trending, you put trades on and you'd expect it to move immediately, but the market takes a long time to play out. We talked about the weakness, but unemployment in the US has gone from 3.4% to north of 4%, and that's taken 9 months, and it just takes time. So although we're repeating the same rhetoric about weaker data, it's getting slightly weaker each time. GDPs,
Absolutely.
PMIs are getting weaker.
And in the oil market, you have a huge market that is able to absorb a lot. So on a gasoline perspective, for instance, you're seeing lack of demand, ample supply, and prices have come off, but they haven't, absolutely flatlined, and margins for refining units still remain pretty respectable. So despite all the conversations around it being very bearish, the market is able to absorb a lot of this, and there are people more intelligent than I and more powerful than I that can maintain prices.
Absolutely. The market, something I find unique about this market is it's largely driven by a few big players.
Yeah.
We had a big revision this week as well. The Bureau of Labour Statistics came out with their annual benchmark revisions to non-farm payrolls. This was fairly staggering. I mean, we knew it was going to come. We didn't know the exact number, but we knew it was going to come, and it is fairly staggering.
Yeah, I mean, this is a potentially the biggest headline of the week, as far as I'm concerned. This really compounds everything. You know, we saw that PMI data. This probably will have been one of the reasons why Powell was forced into his statement. People are unemployed, and you're going to need to sort that out. You have your dual mandate of inflation and employment. This is the employment side going, and I think it's important as well to not sort of just think about recessions as this sort of overarching term. A recession is just a term that is labelled for 2 consecutive quarters of negative growth. Whatever. That doesn't necessarily make that much of a difference. What makes a difference is the people getting squeezed. And so you're seeing people unemployed. I think we're going to go on and talk about searches for holidays and things like that. They've been decreasing because people have less disposable income. Yep. There are more people that are unemployed and have less disposable income in a high inflationary environment. So this is all very worrying and all pointing in the same direction.
And what I find staggering is now this is the main piece of data that market looks at is the first Friday of the month US payrolls, employment data. And an annual revision this week, it was revised down by 818,000. So the BLS basically said they overstated payrolls over 12 months by 818,000. So the number was out just over 30%, 31% inaccurate every month is just staggering.
It's a huge muck up, but the fallout online has been huge and rather comedic as well.
And that brings us to another piece of data, tends to be under the headlines because it's a combination of lots of forward-looking pieces of data, but the US leading economic indicators have now fallen for 29 consecutive months. A good example of, we're talking every week about the data getting slightly worse. It sounds very repetitive, but you can see it's just a gradual and steady process. But the US still has positive GDP. We have Q2 GDP update next week. It's still positive, but what tends to happen with recessions is you suddenly realize you're in a recession and you've been looking at backward data, which is why we look at PMIs so much, because it's probably the best key piece of forward-looking data.
Absolutely, and everyone knows that GDP, if you look at that exclusively, that's a very flawed metric. So I think that might, even if we do get positive figures coming out, it doesn't change anything. Everyone knows what's going on.
Yep. Another one, the regional Fed, regional activity are good for better, more forward-looking indicators. The Philly Fed business activity fell to minus 25.1. You can see from the chart, the previous lows, we're going back to COVID and then financial crisis levels. Again, full-time employment fell from minus 4.9 to minus 14.9. So another regional survey that's painting a pretty bleak picture. Here's the chart you mentioned. Visits to websites of the top 100 brands in each category. People are searching for accommodation, airlines and cruise lines. It's falling. It's a one-way trend.
Yeah, I mean, if interest rates are high, credit's more expensive. We're in an economy where people pay for holidays and things like that on their credit card. In a high interest rate environment, this is more expensive, and the middle class is being squeezed, let alone the rest. So it should be no surprise that we see these kind of, I mean, obviously this doesn't show that no one is booking a holiday by any means, but it's a great indicator that people's quality of life, being able to spend money on things that they enjoy, is falling and going to curtail further.
Yep, and we talked about the payroll adjustment, but what we tend to do each month when we talk about payrolls is highlight the fact that full-time jobs are going down. It's mainly part-time jobs, but also we're having now record numbers of people having second, third, even fourth jobs. So unfortunately, the lower middle classes are really, really struggling.
Yeah, so on our next chart, we'll be looking at the UK CPI that came out. So inflation here did actually come out slightly lower than was expected, and the CPI month on month is down to 0.2%. Now, I think the consensus in the UK, right, is that they've dropped interest rates because they feel like inflation is under control.
Inflation's being combated. What we can see as well is rents. Same in the US, we see rents falling In the UK, we now have deflation for store goods. So inflation really now is a secondary indicator. It's all really about the jobs market. More warning signs from China. Firstly, regulators are telling rural banks not to settle government bond purchases, and China is now mulling government purchases of unsold homes to ease the glut. Going back to, I mentioned this before, what saved the global economy in a financial crisis was the strength of the Chinese economy. It now looks like China's heading down the same route as Japan.
Yeah, I mean, this would be rather radical intervention, wouldn't it? But it just shows that the Chinese economy, when left to its own devices in this state, can't continue to perform at all. It's a pretty bleak picture.
And so what's priced by the central banks into year end? The Fed, actually, I've updated it that we'll see from the next chart. After Powell spoke, it's actually the Fed is now pricing in 100 basis points to year end. Interesting point about that is there's only 3 meetings. So what we're seeing is the market's pricing over 25 basis points for actually the next 5 meetings. So again, if you don't think the Fed is going to be cutting rates that aggressively, paying the OIS would be the way forward. In fact, paying the 1 year, maybe receiving the 1 year forward be an option, but the market is pricing aggressive cuts. Here is the chart of the breakdown, and you can see that we're now pricing 31.5 basis points of cuts for the September 18th meeting. Again, we have on the 5th of September, payrolls, I think, will be critical for that.
If you were a betting man, do you think they drop by 25 or 50 points?
Right now, 25. But again, don't forget, it was 3 weeks ago we had the carry trade blow up.
Yeah.
But again, I think it's likely we're going to see going forward the employment data weakening. And again, if you get something, a surprise weakness there, then the Fed could always just go 50.
Yeah.
Key point again is monetary policy takes 6 to 9 months to impact the economy. So if we're seeing this weakness is going to continue trending.
Yeah, and you'll have a very delayed response, won't you?
Exactly.
Yeah.
So I tend to, it is a line ball. I think it's more 50-50 right now. So I'd expect, I'd be happily receive the OIS at this point.
Okay.
But again, actually, the risk with doing that, of course, in my view, it becomes a binary outcome on the September payroll number, which is not really the way you want to trade.
No.
Interestingly, you can see from here exactly 100 points or 99.5 points of cuts by year end, and exactly 200 over the next year, which is the most that has ever been priced to the OIS market, which is interesting because the economy isn't that weak. It's not COVID levels, it's not financial crisis levels.
Yeah. Obviously, I think a lot of people were expecting more gradual, but definitely cuts over the previous sort of 8 months of the year that we just haven't seen. So to be on parity, I suppose, with where levels might have been, because a lot of people were saying at the start of the year, 5 rate cuts or whatever. So it may end up being towards the levels that forecasters had initially expected. However, for that to happen, it will obviously have to be a steep fall off.
The thing as well is when the market cuts, if you do 150 point cut, all of a sudden those levels are being priced.
Yeah.
150 change is a game changer. And we'll see when we look at the 2-year yield in a second why that could easily happen. Again, just an update of market correlations. You can see here the 3 lines at the bottom, the white, the yellow and the orange are the 2-year yield, dollar yen and Brent. And you can see, well, they sold off aggressively up to 3 weeks ago with equities. That's the NASDAQ is the green line. You can see the correlations. They sold off during the yen carry trade blow up. We've seen a strong recovery in the equities, but you can see now the risk off mentality is coming back in the markets, pricing these cuts again. Gold, we've been highlighting this. It's if it closes where it's trading right now, today, that will be a new all-time high. A classic price action here. It's broken to a new high 3 or 4 days ago. It's pulled back, tested the previous resistance level, has become support. It's bounced off that, and especially with Powell's dovish comments, gold's off to new highs again.
Yeah, that's probably my favourite chart at the moment. You know, we talk about it every week, and I think adding length here is not a bad thing at all.
And a great point, as it makes new highs, it gets more in the news, it becomes self-fulfilling. It's just like Nvidia, just like Bitcoin, retails come in.
Yeah.
The more it's trending, the CTAs get in, and that's how these big trades become self-fulfilling in many ways.
You get that fear of missing out, and that can drive things up further.
Equities, what next for equities? You can see this is the Nasdaq Composite Index. We've had this strong rally. In fact, we had with S&P, we had certainly 8 consecutive up days. We didn't get the 9th earlier this week. If we'd had 9 consecutive up days, well, that hadn't happened since 2005. So it's certainly a big move. Yesterday, we had a big outside reversal day, and at 18,000. And what we had today, the interesting reaction actually. Powell came out with slightly more dovish than expected. 2-year bond yields came off 8 basis points. Equities rallied, and then since then, throughout the day, they've sold off. So where equities would normally rally on talk of rate cuts, now they're starting to struggle, because now that the talk moves not so much about rate cuts, but why the Fed cutting is because the economy is slowing. Trade of the week last week, long Aussie Kiwi, that's actually gone against us 80 pips, but it's still a trade we like. You can see here, Aussie Kiwi orange line and the 2-year interest rate differentials, the white line. I expect that to move higher in the days and weeks ahead. Of course, it could be wrong and the interest rate differentials could come back, but at the moment, the play seems to be that Aussie Kiwi should be moving higher. And chart of the week, the 2-year yield. So you can see here we had about 10 or 15 days ago, actually it's when we had the carry trade volatility, the 2-year yield fell to a support of 3.65, was the exact support back in March of last year. It bounced off that. Now yields are starting to go down again. Interesting point, we have very little on the data front next week, so I'd expect the dovishness from Powell's testimony to follow through. I'd expect the 2-year yield to move back and retest that 365 level, which is why I tend to think, although the OAS is pricing aggressive easing, you can see that's the way the market's trending.
Yeah.
And of course, if that level breaks, then we'd see an aggressive move to the downside. I don't think it's going to break without news, but that could be something like the payrolls on the 5th or the Fed.
Yeah, it doesn't sound as though that much ought to change unless there's some sort of surprise political news or something over the next week or so. So you might expect that to carry on as per.
And if we look back at we won't go back to the slide, but we were talking about the correlations earlier of Brent and 2-year yields. Well, this would imply that the 365 level may tie in with a 72, 71, 55 level in Brent, and everything could move together. It could be a risk-off play that drives it. But what I can see clearly from this chart is if 365 breaks, you'll get an aggressive move lower simply because there's no support. You'll have lots of stops below there, and you would see a swift, aggressive move lower in the yields.
Yeah, I mean, on the Brent side, I think obviously Brent has been flirting a lot and even going beneath 75, which was, it's obviously a support level, and that's been tested many times now. And I suppose it wouldn't be too surprising if we would see some downside and reach that $71.50, $72 level that you were sort of just mentioning.
Again, what's frustrating, it takes time to play out.
Absolutely.
And especially for you, because you're looking at the charts, you're sitting there trading it every day.
No, and the market can remain irrational longer than you can remain solvent, I suppose is always the saying. But things don't have to make sense for them to act as they do. And when people find, key support levels or numbers that they like on an eyeball level, that can really play into things.
Yep. And there's a similar quote, I can't remember the exact quote from Paul Tudor Jones, was we go with the price. The price comes first, the news comes second.
Yep.
So what data do we have next week? Tuesday, we have US consumer confidence. German GDP, again, that's backward looking, but the reason I focus on that, because German data has been so bad. I mean, the PMIs in Germany actually coming in horrific for what is the biggest economy in Europe. Thursday, we have Euro area CPI. Again, I think that's largely irrelevant, but CPI, I think we're going to see that breaking below central banks' targets and more disinflation. US Q2 GDP, we've already had the preliminary review of that, so it's just an update. Jobless claims is again a key. It's a weekly update of the jobless situation in the US. Friday, University of Michigan consumer confidence. So none of that's really key data. All about the price action, and if anything, I would expect the market to keep trending off today's price action. Toddy, anything to finish the podcast with?
I mean, I would just say, you know, it's been interesting, particularly off the back of, as we're recording today on Friday, Powell's speech, seeing a bit of a delayed reaction even to that on equities and crude. Similarly, it wasn't upon hearing the speech that everything decided to sell off, but I think sentiment clearly changed, and so yeah, it could be one of those situations where things don't necessarily move incredibly fast, but sentiment and trader mindsets can really shift over the next week or so. So despite us perhaps not having the most significant bits of information coming out over the next week, you may still see a change in sentiment, which could lead to some interesting price action, I'm sure.
Of course, it is at the end of the day all about price action. I think you hit the nail on the head there with equities. It's not the normal reaction. From a dovish central bank commentary, to see equities going down is unusual and slightly concerning. Although personally, I think equities, certainly the tech sector, is still at expensive levels. So that wraps up this podcast. Hopefully you have a great week, and we look forward to catching up with you next week.
Thank you very much, and please like and subscribe, and even leave a comment on the podcast.